Hello, ladies and gentlemen. This is Thomas Fross with Fross and Fross Wealth Management, where, as always, we at least attempt to be the voice of reason in a world full of the pundits of pessimism and that scary wall of worry. Now, for those of you that I may not have met personally, along with my team, we've been serving villagers' needs for nearly 25 years. So what I thought I would do is just take a couple minutes and talk about what we're looking at in the markets as we head into 2026. Now, you're likely going to hear noise in the coming months about a few things that could cause some short-term market bumps. Think of it like a speed bump. They're not comfortable, but if the vehicle is built safe, they should not cause a wreck. And one of those is the possibility of yet another government shutdown. Now remember, we've seen this movie before, we've lived through several of them, and while they're frustrating and certainly make for great news headlines, historically they've been more noise than long-term damage to portfolios. Another topic that you might hear about is the Supreme Court decision involving the White House and their tariffs. Now, depending on how that all shakes out, it definitely could affect certain companies and certain sectors. It is important. However, it's not something that should cause damage or cause big changes to a retirement plan. And then, of course, there's the talk about the Federal Reserve, especially who might be the next Fed chairman and what that could mean for interest rates. And whenever interest rates are in the news, the markets tend to get a little choppy. Now, here's the reassuring part. Even with all this going on, the outlook for 2026 is still expected to be positive. Just probably not the kind of year that we've gotten used to recently. You see, the fact is we've just seen 3 consecutive years where the S&P 500 has been up double digits. That's not the norm. That's the exception. In the post-war era, we've only seen 3 consecutive years of double-digit performance 3 times. So it's not the norm. The fact is the market has done very well, largely driven by a small group of 7 technology stocks. And going forward, returns are expected to be a little bit more modest, maybe in the mid to high single digits. And for retirees, that shouldn't, and pre-retirees, that shouldn't be a problem. That's actually more than normal and a healthier environment. Now, what might be even better news is that areas outside those big tech names we expect to do just as well, if not better. And that's kind of broad market participation is actually very good for a diversified portfolio. And this is where I want to bring it back to the villages. Most of the folks I work with here, I would say they're not trying to beat the market or chase some hot stock. You're focused on predictable income, preserving that nest egg that you've spent so many years building, and then maybe most importantly, sleeping well at night. And that's why we built plans designed to handle markets ups and downs, so you don't have to react to every news headline and every election cycle. Well, if you have any questions about your own portfolio and how it's positioned going into 2026, or you just want to sit down and talk things through, that's exactly what we're here for. Well, thank you for spending a few minutes with me. Welcome to 2026, and we look forward to seeing all of you soon. Have a wonderful day.